Hello and welcome to week 18 analysis session. I'm your host, the King, the owner and curator of the King's Print. Starting this analysis session off, we are going to look at the economic calendar. IMF meetings did conclude today, Monday the 28th, Canada federal elections, whereby we're going to see how many people are going to be voted into government, and this will have an impact on the Canadian dollar starting off tomorrow. Whatever happens with the people who were put into place is going to have an impact on the monetary policy. Moving on to Tuesday, it's going to be a bank holiday for Japan. We don't anticipate a lot of activity happening, but later on in the day, we do have JOLTS opening for the United States dollar. Expect the number to come out almost at 7.48 million jobs being opened. Now, this one usually tends to be overshadowed by the NFP numbers, which usually come out on Friday, but it's an important leading indicator of consumer spending, which accounts for a majority or overall economic activities. We do have CB consumer confidence coming on at the same time, 5 p.m. UTC plus 3. The numbers coming out at 87.4, which is quite relatively low compared to the previous numbers. And we're going to see over the past few releases, we have been seeing consumer confidence taking a tumble from 111.7 back in November 26th. Right now, we are forecasting 87.4. These are data that is derived from about 3,000 households, which asks respondents to rate the relative level of current and future economic conditions, including how do you feel about labor, business conditions, and overall economic situation. This is a leading indicator of consumer spending, which accounts for a majority of overall economic activities. On Wednesday, starting the day off early in the morning at 4:30 a.m. PI for the Australian dollar, whereby we do anticipate inflation numbers picking up to 0.8% on the quarter, but coming back down to 2.3% on the year-on-year release. At the same time, we do anticipate manufacturing PMI for the Chinese yuan. Why do traders care? It's a leading indicator of economic health. Businesses react quickly to market conditions, and their purchasing managers hold perhaps the most current and relevant insight into the company's view of the economy. Later on in the day, we do have ADP non-farm employment change for the United States dollar. 15 minutes later, we are going to have advanced GDP for the quarter and employment cost index also for the quarterly numbers for the United States dollar, and at the same time GDP month over month release for Canadian dollar. Later on at 5 p.m. we do anticipate core PCE index numbers for the United States dollar. Moving on to Thursday, we do have Bank of Japan policy rates, whereby we do anticipate the Bank of Japan to hold their policy rates at 0.5%. It's going to be a bank holiday for the Swiss franc and the euro zone in general. Later on in the day, we do have unemployment claims for the United States dollar, whereby we do anticipate the numbers coming out at nearly 224,000 jobs. At 5 p.m., we do anticipate ISM manufacturing PMI, whereby we do anticipate the numbers to come out slightly lesser than the previous number at 48.0. The highlight of the week is going to be on Friday, non-farm payrolls, whereby we do anticipate the job numbers coming out at 129,000 jobs, which is quite significantly lower than the previous numbers. We will learn to see how these numbers are going to affect the markets, which brings us to the next point, which is commitment of traders. Under the commitment of traders, we are going to start with the metals. We are going to look at futures only, and we'll going to look at silver. So this is data as of 22nd April from 15th April 2025. We can look at almost 1,000 positions were added to long positions and almost 1,300 positions being offloaded from short positions, meaning institutions are favoring more long positions on the silver metal. Moving on to gold, we did see almost 2,000 positions being offloaded from the long positions and almost 1,900 positions being added to shorts, meaning institutions currently at the moment from 15th to 22nd April did favor selling opportunities on the precious metal. Moving on to financials, Canadian dollar, when we look at asset management institutions, we did see almost 14,000 positions being offloaded from short positions, which is quite significant, and only 1,000 positions being added, meaning institutions are going to favor more long positions on the Canadian dollar, whereby they have covered quite a significant amount of short positions and have added a small amount of long positions. Moving over to the Swiss franc, we did see 626 positions being offloaded and 737 positions being offloaded from the short positions, meaning the numbers are going to be almost similar. If you have one lot size being bought and one lot size being sold, the market is not going to have much of an impact. Moving over to GBP, we did see 8,900 positions being added to longs and 3,559 positions being offloaded from short positions. Japanese yen, 5,241 positions being added and 166 short positions only being added, meaning the Japanese yen is still a safe haven according to the institutions. When we look at the euro, we did see almost 6,000 positions being offloaded from short positions, and this makes sense because the euro did decide to lower the interest rates and institutions would want to cover their positions to much more carry trading bearing markets. Moving over to the Dow Jones Industrial Average consolidated, this is the Chicago board, whereby we did see 2,739 positions being added and only 31 positions being offloaded from the short positions, meaning institutions are looking at the Dow Jones moving to the upper side over the long-term perspective. When you go to the S&P 500 consolidated, quite a significant amount of positions were added on longs, while also quite a significant amount were added on shorts. But if you look at the net long positions, we do have 1.12 million and net short positions at 304,000, meaning institutions are favoring the S&P 500 to continue moving further to the upper side. They are net long on the S&P 500. When you go over to the Nasdaq, we did see almost 3,000 positions being offloaded from longs and 3,000 positions being added to short positions. Now this comes after the tariffs that impacted the tech-heavy Nasdaq, and we will going to see what this means moving forward, where the Nasdaq is being favored more to the selling opportunities compared to the long opportunities. Moving over to the Russell E-mini, almost 8,000 positions being added to longs and only 500 positions being added to the short positions, meaning institutions are favoring more long opportunities on the Russell 2000 index. Switching gears over to the charts, starting off with the screeners, we'll want to see what the stock markets are doing over the past few trading days. Looking at the S&P 500, most of the stocks are recovering at the moment. Russell 2000, we did see institutions favoring more long opportunities, and the stocks are currently gaining back what they had lost in the markets. Looking at the Nasdaq, we did see quite a significant amount of longs and short positions, almost similar positions being added as a result of the commitment of traders data. But the biggest gainers that we'll want to look at is the S&P 500, whereby most of the stocks have started regaining, Tesla being up 17%. Starting us off with XAUUSD, on the 1 hour time frame, we did see quite a significant amount of bears coming into the markets Tuesday and Wednesday of last week, whereby we did see almost 6% of the total value of gold per ounce being lost in the financial markets, and then we had a short-term retracement. Could this be an indication that the markets have found their top and we might start seeing corrections of this entire move back to the downside? I would want to wait for markets to open, come back to this region, relatively equal highs that we do have residing at 33.69, whereby I would want to look for short opportunities of this market. Stop loss is going to be based off the Fibonacci retracement, whereby I would want to have my stop loss just above the 50% region, and I would want to target the equal lows that are at 32.59 for a risk to reward ratio of almost 1:5. Quite a decent trade range to be looking at for this opportunity on gold. Looking at the dollar index, the dollar index has started recovering, meaning I would want to look into more buying opportunities in the dollar this coming week, whereby we did see over the past 4-5 trading days whereby the dollar index had been gaining strength after this period of consolidation that we did have from 11th April 2025. We want to see the dollar index gaining back to highs that were made back in January 2025. Moving over to the volatility index on the daily time frame, we did see the volatility index sharply make this 60% tap when the trade wars were at their highest, and afterwards the markets did calm down back into the 25% region, meaning that we could be moving back into normal market conditions in the near future, showing us that okay, the markets are coming back down and whatever was happening, the storm is behind us right now. Looking at the S&P 500, whereby we did see it close above 5,484, which is quite significant after Trump did announce the pausing of the 90-day tariffs back in 9th April 2025. If I was to execute a long position on the S&P 500, I will first have a Fibonacci from this low to this high, which brings me to this region of inefficiencies that we do have around this region. Let me mark it out first. If the market comes back down to this region, I would want to look for further buying opportunities to the upper side, whereby I would want to look at buying opportunities when prices reach this magical retracement zone of the Fibonacci, targeting the highs back at 6,000. The last time we were there was 18th February 2025 for a risk to reward ratio of nearly 1:10, which is quite decent in the financial markets when executing. The same thing I would want to look at on the Nasdaq, whereby I would want to wait for prices coming back down to this inefficiency, this gap that we did form around Tuesday, Wednesday market open, whereby I will anticipate the markets coming back down to this region and then a further push to the upper side, meaning I will want to look for long opportunities when the market comes to those regions of inefficiencies. My take profit one is going to be Friday's closing price, but I would want to swing this trade back to these highs that was formed also on 18th February 2025. Moving over to the US 30, similar structure that we are seeing. There's a region of inefficiencies around here, whereby I would want to look for long opportunities if the market comes back to that region. My stop loss just below the inefficiency region. Take profit one is going to be just around these highs that was formed after the pausing of the tariffs. TP2 around 42,856, but my final take profit will be around $45,000. Russell 2000, you're not going to execute on that. Moving over to the treasuries, we did see quite a significant region of demand forming around $85 on the US 20-year treasuries, and we'll want to see if this region is going to hold, but I would anticipate that the markets will start gaining to the upper side on the treasuries for the 20 years. Moving over to Brent oil, last week there were positive talks about the wars in Middle East coming down, and these did prove very vital for Brent oil, whereby we did see it close around $65 a barrel, which is really good because we were heading towards the recession territories of $58 a barrel, which was quite alarming for the oil markets. WTI, similar thing happening, and I would want to see prices coming back to this region of inefficiencies. If I was to execute a position on WTI, I would want to pull a Fibonacci from these lows to these highs, looking for an entry just around the magical region here whereby I would want to place a buy order targeting these regions of inefficiencies, and my stop loss is just going to be below the 50% region on the Fibonacci. Bitcoin USD, we did say gain almost 30% from the lows that were created at the start of this month to where we are currently at the moment at 30%, meaning we might see further push to the upper side. If you do get a correction on this move from this low to this high, I would want to wait for prices coming back to the regions, to the golden retracement region, looking for further opportunities to the upper side. Take profit one is going to be Friday's closing price, whereby I would want to wait for prices opening, come back down to this region of importance to me for a further push to the upper side to all-time highs. Euro USD, after the ECB did lower the interest rates last week, we did see it lose quite a significant amount of this leg that had formed over the past few trading days, but we did grab liquidity around 1.13056. If I can just clear my charts, we did see this candlestick here was of importance to me, whereby we did see Thursday's candle open without a wick to the bottom side, close very bullish, and Friday's candlestick did open, come back down, fill those inefficiencies around 1.13200, and the markets did reject that region quite significantly. So when the market opens, I will want to look for buying opportunities on euro dollar further to the upside. Moving over to GBP USD, similar instance whereby we did see the markets retrace quite significantly. If I was to pull a Fibonacci from this low to this high, prices has not yet come back to the retracement. Moving over to United States dollar against the Swiss franc, I would want to look at this trend continuing further to the downside, whereby we did have a short-term retracement around this region. If I was to pull a Fibonacci from this most recent high to this recent low, we did see prices coming back and tapping into the magical retracement region, whereby I'll anticipate further short positions of this market moving to the downside, whereby my take profit is just going to be at these lows. My stop loss is going to be above these candlestick highs. Risk to reward ratio 1 is to 3.3, which is quite doable for me. If you have reached this part of the video, I want to appreciate you. This week is going to be very crucial for us traders, especially with the non-farm numbers about to come this Friday. We'll want to see what the market has in store for us. Stay safe. Have a peaceful week ahead of you.